Today's section is on income tax. More fun stuff. Okay. Income tax preparation flowchart. Now, to tell you the truth, the way tax is figured is a little bit different from this. This is from 2017. It changed in 2019 to where there's not separate deductions and what is it? There's not separate deductions and exemptions. Yeah. So we're looking back at 2017 here. It's not quite current, but it's still similar. You still get the idea. Other than taking out the exemptions. So here's how you prepare income taxes. You take your gross income, how much you made before taxes. Subtract the adjustments to your income. We'll talk about those, what those could be. And that gives you your adjusted gross income, which they'll call the AGI. Take that number, subtract your deductions and exemptions. That gives you your taxable income. So your taxable income is all your taxed on. Not the gross, not even the adjusted, but just what's taxable. Subtract tax credits from that, and that gives, or do your tax rate stuff, which we'll do, and subtract tax credits. That gives you your total tax. Subtract any payments that you've already made or that you haven't made. And then that gives you either the amount you owe or the amount of your refund if you've paid more over the year for taxes than you should owe. Example 1 says, Karen earned wages of $38,200, received $750 in interest from a savings account, and contributed $1,200 to a tax-deferred retirement plan. She was entitled to a personal exemption of $4,050 and deductions totaling $6,350. Find her gross income, adjusted gross income, and taxable income. Well, her gross income is the $38,200 plus the interest, $750. So $38,950. Her adjusted gross income is $38,950 minus anything contributed to a retirement plan. So like the $1,200. $37,750. Then her taxable income is the $37,750 minus exemptions and minus deductions. So our taxable income is $27,350. There are 4 different filing statuses. There's single, obvious, married, filing jointly, married, filing separately, or head of household. And that's the case where if you're like unmarried, but paying more than, if you're unmarried but have children, okay, then you can claim head of household. And that gets you a little bit better than filing single. Exemptions are a fixed amount per person across the board, no matter how much money you make. That's what they got rid of this year, or in 2019. Deductions vary from one person per other. There's either a standard deduction, which depends on your filing status, or an itemized deduction. And that is if you contribute to a whole lot of charities and stuff. You think that bag of, $100 worth of clothes you're taking to Goodwill is going to help you? Nope. But it's good to take it to Goodwill. Still good. But it's not going to help you to get that tag unless you're donating a lot. Okay. Suppose you have the following deductible expenditures. $4,500 for interest on a home mortgage, $900 for contributions to charity, and $250 for state income taxes. Your filing status entitles you to a standard deduction of $6,350. Should you itemize? So this is the point that I'm trying to make here. If you itemize, then you would take $4,500 plus $900 plus $250, and you would have $5,650 to deduct at the end of the year. But your standard deduction is more than that. So you would take the standard deduction. A progressive income tax means that people with higher taxable income pay at a higher rate. And they do. They also get more, we'll see later on, they also get more for their donations too, though. Marginal tax rates are assigned to different income ranges or margins. So here's the 2017 marginal tax rates. Here's what it says. For example, if you're single and you make up to $9,325 in a year, then your tax rate is only 10%. While if you're single and you make up to $191,650 per year, then your tax rate is 28%. Now, that's not quite true though, because you're only taxed 28% on the amount between $91,900 and $1,091,650. You're taxed 25% on that. Then between this and this, you're taxed 15%. And between here and here, you're taxed 10%. So you're not really taxed 28% on everything. It's just, it bumped you up, so you are getting taxed that on some things. But once you get back down, it changes. And so that's why I'm going to do the next example with 3 different examples so we get that clear, because it's a little bit complicated. As a rule, tax credits are more valuable than tax deductions, because a tax credit reduces your total bill by the full amount of the tax credit, while deductions only are deducted from your taxable income. Okay. So example 3 says, using 2017 rates, calculate the tax owned by each of the following people. Assume they all take the standard deduction and neglect any tax credits. So Deidre is single with no dependents. Her adjusted gross income is $90,000. Okay. So, first, we find the taxable income. We'll do this every time. And the taxable income is the adjusted gross income. I'll write it out the first time. Minus exemptions. Minus deductions. So $90,000. We're going to go back and look at exemptions and deductions for a single person. Get rid of this. So if you're single, you get an exemption of $4,050 per person. There's just one of her, so that's just once. And a standard deduction of $6,350. So we take off $4,050 and $6,350. And so her taxable income is $79,600. So we look and see where that puts her. $79,600 puts her in the up to $91,900. Okay, but like I said, it's not 25% of $79,600. First, it's 10% of $9,325. So her income tax is, lots of parentheses here, 10% of $93.25 plus. Then it'll be 15% of, let's use a bracket here. $15% of the amount between here and here. So we have to subtract $37,950 minus $93.25 to get the amount in between. That's what she's taxed 15% on. Plus 25% on the amount from $79,600 down to, not all the way up to that, just what she has, down to the $37,950. Okay? So we've got 0.10 times 93.25. I'm going to write this all out the first time, and later on I won't. Plus 15% of, we're going to subtract there. That is 28,625 plus 25% of, and we subtract 41,650. So go through and multiply. We get $932.50 for the first part. $4,293.75 for the 15%, and for the 25%, $10,412.50. That totals to $15,638.75. Now, they don't charge you cents in your taxes, so they always round up. always. Even if it's just 1 cent, they round up. $15,639 is how much she is going to owe. Okay, so let's look at another example. Robert is a head of household, taking care of 2 dependent children. He's not married. His adjusted gross income is also $90,000. So we first find his taxable income, $90,000, minus his exemptions and deductions. So way back here, he is head of household. And so he's got a standard deduction of $9,350 and exemptions of $4,050 per person. So 3 times $4,050 because it's him and his 2 children, and $93.50. So his taxable income goes down to $68,500. So how much is he paying in income tax? So we go back under his head of household, and up, it'll be $68,000 up to there. So he's also in the 25% bracket. But it's 10% up to this amount, then 15% up to this amount, and 25% above that. So, 10% of $13,350. I got that back from the table, okay? 15% of $50,800 minus $13,350. Both of those are from the table. Plus 25% of his taxable income minus that one step lower, $50,800. Okay? And I'm not going to go through every single step this time. When you multiply the first one, you get $1,335. When you subtract and then multiply for 15%, it's $56,117.5. And for the 25%, subtract, then multiply. Why do we subtract first? Because it's in parentheses. 10,400. Nope, looking at the wrong one. 4,425. So that's $11,377.50. Always rounds up to $11,378. So he's paying a little bit less because he's got dependent children. And then C, Jessica and Frank are married with no dependents. They filed jointly. They each have $90,000 in adjusted gross income, or a total of $180,000. So their taxable income is $180,000 minus married filing jointly. The standard deduction is that, and of $40.50 per person. So 2 times $40.50 and minus $12,700. So their taxable income is $159,200. That puts them over this one, because it's 153. So puts them in the 28% tax bracket. So we're going to do the same process again using these numbers, but I'm not going to switch back and forth. When you're doing this, I'd have that table in front of you. Make it a lot easier. So, 10% on the first 18,650 plus 15% on the amount from the table 18,650 minus, I wrote that backwards, 75,900 minus 18,650 plus 25% on the amount from up to 153,100 minus 75,900, and 28% up to what he makes. So they make 159,200 minus 153,100. Okay, so for the 10%, it's $1,865. Subtract and multiply for the 15%, $85, $87, $50. Subtract and multiply for the 25, $19,300. Plus for the 28, subtract and multiply, $1,708. $31,460, $50. Round up, $31,460 and $61. Okay, so hopefully after 3 whole examples, you get the idea. Example 4 says, suppose you are in the 28% tax bracket. How much does a $1,000 tax credit save you? How much does a $1,000 charitable contribution, which is tax deductible, save you? Answer these questions both for the case in which you itemize and which you take the standard. Well, in either case, a $1,000 tax credit saves you the full $1,000 and is deducted from your bill. Okay? The $1,000 charitable donation reduces your taxable income. Not your total tax bill. So if you're in the 28% tax bracket, 28% of $1,000, it's going to save you $280. Then, if you itemize, so if you itemize, the $1,000 only saves you $280. If you take the standard deduction, and don't itemize, the $1,000 gets you nothing. Remember, if you don't go over the standard deduction and the amount that you donate, then it's not going to get you anything. Example 5. 3 more examples. Drew is in the 15% marginal tax bracket. Marion is in the 35% marginal tax bracket. They each itemize their deductions. They each donate $5,000 to charity. Compare their true costs for the charitable contributions. So there's Drew and Marion. So Drew is in the 15% tax bracket, and 15% of $5,000 is $750. So $750 is taken off their taxes, and so the true cost is $4,050. So they paid out $5,000, but they're getting back $750 of it. So they're really only paying, in the long run, $4,250. Marion is in the 35% tax bracket. She makes more money. So she gets a higher tax rate, but she also gets a higher amount on her deductions. And it's not broken down, 10, 15, blah, blah, blah. It is the whole 35%. So she saves $1,750. So at the end of the year, her true cost, since she gets back $1,750, she's only really paying $3,250. Okay, Social Security and Medicare taxes. There's something called FICA that adds on to your regular income tax. And this is your Social Security and Medicare. And Social Security and Medicare you pay each month. And supposedly that goes into an account in the federal government. And when you retire, you start getting that money back, supposedly, with interest. And that's the way it works right now. The worry is that the government's going to run out of money and we won't be able to get that money back that we paid. Anyway, we won't get into that. So FICA applies to the following: income from wages, including tips, and self-employment. It doesn't apply to interest, dividends, or profits from stock, okay? Just from wages. In 2017, we're going to do one more of these long problems, but this time adding on the FICA tax. Jude earned $26,000 in wages and tips from her job waiting tables. Calculate her FICA taxes and her total tax bill, including marginal taxes. What is her overall tax rate on her gross income, including both FICA and income taxes? Assume she is single and takes the standard deduction. So first off, her FICA it's always the same for everybody, 7.65%. So 0.0765 of $26,000. $1,989. So what went into for Social Security and Medicare for her. Okay, next we need to find her income tax. To do that, we first find her taxable income. Remember? We take $26,000 and deduct off exemptions. You can look back at the table, and deductions. Her taxable income is $15,600. If I ever move too fast, just pause or rewind, okay? Income tax, then, is 10% on the first $9,325. And she's just in the 15% bracket. So 15% on the 15,600 minus 9,325. So her taxable income is $1,874. Therefore, her total tax is the FICA, $1,989, plus the income tax, $1,874. The total she pays is $3,863. And so the last question asked, what is her overall tax rate? So that's just saying take her total tax and divide by her gross income, and that's just giving the overall tax rate, what it would be overall. I don't know how else to say it. So the total tax is $3,863. Her gross income was $26,000. Gets 0.149. So her overall tax rate is 14.9%. Okay, that means that overall, that's how much she paid. She was in the 15% tax bracket, but because it breaks it down and because of the FICA, it ends up being 14.9 overall. Dividends. These things have special tax treatment. Dividends on stocks, capital gains, profits from the sale of stock or other property. Short-term capital gains are profits sold on items sold within 12 months of their purchase, and long terms would be more. Tax-deferred income. Tax-deferred saving plans allow you to defer income taxes on contributions to certain types of saving plans. So you could, on a retirement plan, or if you wanted to get a medical, like a medical plan for the year or something, not insurance, but like a medical plan where you put a certain amount in each month, then that will come off before taxes. And it will come off your gross income before you get to the adjusted gross income, and you don't have to pay taxes on that. Okay, so it's kind of a nice thing. Suppose you are single and have a taxable income of $65,000 and make monthly payments of $500 to a tax-deferred savings plan. How do the tax-deferred contributions affect your monthly take-home pay? So you're in the 25% bracket. Each $500 contribution reduces your tax bill by 25% of 500, or $125. So your paycheck goes down by 500 minus 125, or $375. So what we're saying here is you're putting $500 into this plan, but you're really only spending $375 because of your tax bracket and because it's going in before taxes are taken out. Okay? And that might sound great, but you can't get to that money easy. Okay? And same thing even with the medical plan. You can't get to it. Well, you can get to it easy, but it only lasts for a certain amount of time. So let's say you have $2,000 left at the end of the year in your medical plan. You can't get all that back at the end of the year if you don't spend it on medical expenses. So you really have to think about what you want to do and what's best for you. Okay. Finally, the end of this section. And I believe the end of the chapter.